Thanks very much. I'm not going to stand behind the podium because, quite frankly, you don't want an economics lecture. And the minute I get behind podiums, that's what it actually turns into. I do a lot of presentations for universities, for college students, and you always have to give your presentation behind the podium. I find it very uncomfortable. What my objective is to basically give you a whirlwind economic and financial update, talk a little about where we're going, what the big risks are. You know, when you look at the title of today's seminar that they had up there, is Greece, Globalization, America, Uncertainty, and then of course, you know, they ask, well, can you make sense of it from the point of view of the BC economy? And by the way, we had a budget. Could you please comment about the budget? And your thoughts about, you know, where we're going with interest rates, commodity prices, currencies. And can you do it in 25 minutes? You know, I'm not going to do it in 25 minutes. I'm going to do my best to do it in 35 minutes. But it is going to be a real tour de force. We're going to be going around the world very, very rapidly. But then at the end, I promise you, we'll draw it all back and make sense as to what it means for BC and for Vancouver. So what's the dominant economic story that's playing out? Well, after the most synchronous global recession of all time in late 2008, early 2009, the global economy has been experiencing a recovery. Now, in fact, when the recovery started, there was a lot of debate about what the shape of that recovery would look like. And you might remember this because it was an alphabet soup. Was it going to be a V, a sharp decline followed by a sharp rebound? Was it going to be a U, where the economy stops going down but it's flat for a long period of time? Was it going to be a W? Oh, we didn't want a W, right? W was a double dip. So what actually transpired was the global economy snapped back in 2010. We had quite solid global economic growth. But then things started to decelerate in 2011. And this really created a lot of concern and uncertainty, and it created a lot of frustration. Businesses felt like they couldn't get a break, and investors felt like it wasn't fair. You know, the market once again was going through wild swings, incredible amounts of volatility. So let me explain why we've been living in this environment. So really, from a global perspective, we've had a two-speed global economy. We've had rip-roaring growth in the emerging market world. You know, where China in 2010 was growing at north of 10%. But we've had very lackluster economic recoveries in the advanced world. Now, the good news is that from an advanced economy perspective, actually Canada's been an outperformer. The recession was milder than most. The recovery actually has been stronger than most. But I would say most Canadians probably don't feel that positive about the economy. I think most Canadians still feel like it's difficult economic times. And it's a reflection that this has not been a sharp rebound in economic growth. It's been a slow grind going forward. The outlook is that the emerging market economies are slowing down. Yeah, our projection in December was that Chinese economic growth this year would drop to 7.8%. Well, this week, the Chinese government announced that their target for growth this year is 7.5%. So we're seeing a significant slowdown in Chinese economic growth. India is probably going to grow at about a 6% pace. Now, my sense is that these economies are not going to have a hard landing. My sense is that we're going to see their economies slow down, stabilize, and then start to come back up. And so I actually think that this is a positive outcome from a global perspective because the rates of growth that these economies were having was unsustainable. It was creating inflation problems. So now they're heading into a more moderate pace of growth. But keep in mind about the numbers we're talking about here. You know, I think the Chinese economy will slow all the way down to a 7.8% growth rate, a mere 3 times what we are likely to get in the advanced world. So the structural change in the global economy is still taking place. When we look at the advanced world, the Japanese economy contracted last year because of Mother Nature. The earthquake, the tsunami, the nuclear disaster that came out of that derailed the Japanese economy. Now, as we look forward, the Japanese economy is likely to grow at about 2% the next couple of years, but half of that will be rebuilding from the natural disaster. When you take out that effect, the Japanese economy is probably chugging along at a trend rate of growth of about 1%. There's still lots of interesting business opportunities in Japan. Japan still is a very good investment picture because Japan is the #1 exporter to China, and what it exports is high-tech products China needs for its economic development. But in terms of a contributor to global economic growth, Japan is going to be well down on the rankings. But the big story on the international front has been Europe for the last for the last year or so. And I gotta be honest, Europe has been the slowest moving train wreck of all time. You know, in early 2010, Greece had issued bonds worth 30% more than the entire value of their economy. And the holders of those bonds very rationally looked at them and said, no, wait a second, am I going to get the interest I'm due? Am I going to get the principal back, or is this government going to default on me? Very quickly, they used Greece as the canary in the coal mine. They said, if Greece has a problem, who else has got a problem? And they came up with Ireland, Portugal, Spain. By the summer of 2011, markets started to worry about Italy defaulting on its debt. Now, this took the financial crisis to a new level of magnitude, because Greece is a very small country. Even within the Eurozone, Greece is a small country. You can bail out Greece. Italy is a G7 country. It is also the third largest issuer of debt in the entire world. There is not enough money in Europe to bail out Italy. So the escalation of the financial crisis last year was extraordinarily troubling. And the problem was that the European politicians didn't seem to be able to get ahead of this thing. At every given step, they kept coming up with a new plan, but by the time they finalized the plan wasn't enough. And so they didn't implement the plan, and they went back to forming the next plan, and things just steadily got worse over the course of the year. Now, in early December, TD has a meeting of all of the senior executives of the bank, every titled officer. It's a big event. And I had to present at it. And when I was asked to present at it, the corporate and public affairs people that run the conference came to me and said, you know what, people don't want dry and stuffy economic slides. They want pictures. They want illustrations. I said, okay. So I took a picture of the cover of an Economist magazine from late October. And it was a picture of a black hole. And at the top of the page in white letters, it said, until politicians actually do something, ... And in the middle of the black hole, in large cap red letters, it said, be afraid. Very quickly, Kappa came back and said, dry and boring economic slides would be perfectly fine. Right? But it really did capture the risks that we were at. Now, when I looked at the situation in Europe, the Europeans understood the risks that were playing out. From a Canadian point of view, it isn't so much that Europe is heading into a recession that's the problem. You know, the European economy, with all the tax hikes and the cuts in spending, the European economy will contract in the coming year, but we don't do that much trade with Europe. And from a financial system point of view, Canadian banks have very little exposure to the at-risk government bonds. So the only way Canada gets really impacted by Europe is if they really lost control of it. You had several governments defaulting on their bonds, and the concern there is that a lot of those bonds are held by the European banking system. And so if you have large-scale government bond losses, you could actually cause insolvencies of big European banks. If this happened, it would be like the environment we had after Lehman Brothers failed in the United States. So make no mistake, the risks, if this is not contained, is enormous. In fact, I'd argue it would be worse than 2008. Because rather than being one government dealing with one financial system, it would be 17 governments dealing with 17 financial systems. And what you're really saying is that insolvent governments would be bailing out insolvent banks. So if they lose control over it, this would be catastrophic. Now, in late December, there was no sign of progress, and we had to do a forecast for the coming year. And our assessment was that since the Europeans actually understood the risks that were out there, what could happen if they lost control of the situation, we assumed rationality would win out. At the end of the day, they would do what's necessary to prevent the financial catastrophe. But I gotta say, it was very uncomfortable because you don't know what's gonna happen in politics. Well, close to 3 months have passed now since we did our forecast. And actually, I have to say that things in Europe are playing out far better than we anticipated. And we're actually seeing fundamental progress in all the areas that are needed. There's really three things Europe had to do this year. Number one, Greece had to be allowed to default. Greece is insolvent. They cannot pay their bills. No amount of fiscal austerity is going to help. The more they push on raising taxes and cutting spending, the more the Greek economy will contract, the weaker their ability to meet their financial commitments will be. So they're past the point of no return. They have to default. Number two, when Greece defaults, we have to ensure that other countries don't follow the same path, that it isn't a set of dominoes. And that's what financial markets call contagion. So we have to ensure there's policies in place so that financial markets don't panic and actually expect Portugal, then Spain, then Italy to default. We have to contain the crisis. The third thing is Europe has to rebuild the banking system, and that means basically putting more capital into the banks to make them healthier. So what's happened since early December? Number one, we've reached a point where the terms of a private sector voluntary debt restructuring of Greek debt is going to happen. It looks like the private sector is going to take a financial loss of about 54% or thereabouts on the value of their Greek bonds. Now, they're not out of the woods for a couple of reasons. Number one, while the terms of the restructuring has been agreed to, you actually have to get the institutions to pony up and say, here's my bonds, I'm willing to take the financial hit. On Monday, it was only about 20% of the holders were saying yes. Today, the news is that more than 50% are willing to actually tender their bonds. In truth, they probably have to get to 70 or 75% for this to be effective. The second point is it's actually not enough. It's a good start. Quite frankly, I think that if the private sector restructuring goes through, it'll effectively take the pressure off Greece for about 12 months, but don't hold me to the exact number. And what we're going to find is the continued contraction of the Greek economy means that they're going to have to come back and they're going to need more support. And ultimately, I have to be honest with you, I think Greece ultimately is going to have to leave the Eurozone. I just don't see another option for it. However, if the Europeans can draw out this process for Greece, and they can actually put in place the policies to prevent contagion, they can actually make it such that when Greece leaves, it doesn't create a financial catastrophe. So on the contagion front, we've also had progress. The missing ingredient when the euro was launched was they had one central bank with one currency, but they didn't have a common treasury. They didn't have constraints on what governments could do from a fiscal point of view. And it's absolutely essential to have that if you're going to have a structurally sound currency. Now, at the time when the euro was launched, the politicians couldn't agree to the terms of the fiscal union. Because at the end of the day, what you're asking is, you're asking a politician to give up sovereignty. You're saying, you know what, although I'm the government of Greece, I'm going to allow somebody else to tell me what I can and can't do on fiscal policy. So no politician wants to do that. So here's a question for you. How do you get a politician to do something they don't want to do? The answer is you have a financial crisis, so they don't have an option. And this is why it's been such a slow-moving train wreck. Because the financial crisis has been the force pushing the politicians to make the changes to have the fiscal union that's necessary. So just the other week, we had an announcement that all the members of the Eurozone have agreed to a fiscal compact with the exception of the UK and the Czech Republic. Well, the UK is not in the Eurozone, and I don't actually know the answer as to why the Czech Republic didn't sign up. But ultimately what you have is progress towards an element of a fiscal union. Again, I don't think Europe's out of the woods. I have a lot of questions about whether the fiscal compact is going to have teeth and whether it's going to be enforceable, etc. But Europe is going in the right direction, and as they move towards a fiscal unification, it means the Germans can be more supportive of putting in place the policies to prevent contagion. The third thing they had to do was rebuild the banking system. And the most positive thing that happened out of everything over the last 3 months is the European Central Bank on December 20th announced that banks in Europe could effectively borrow an unlimited amount of money at 1%. So what they were saying was they were going to be the lender of last resort to the banks. No bank would fail while governments put their fiscal houses in order. And that took away an enormous risk. And if you remember back what I said about, from a Canadian point of view, what is the most, what do you need to see, right? Or how is Canada most vulnerable? The answer is we're vulnerable if they have a banking crisis. Well, they took actions to ensure that isn't a likely outcome in the near term. And quite frankly, they can borrow at 1% and then invest in Italian bonds at 5.5% or 6%. And that difference in yield means that actually they're making a lot of profits, which is helping to rebuild their balance sheets. So in all three regards, Europe is actually heading down the right direction. I gotta be honest, I think markets are being too complacent. I don't think it's gonna be as easy as they think. I think Portugal is gonna need a second bailout. I think that'll cause markets to get worried about Portugal. So Europe is gonna be a protracted, messy affair. It's gonna contribute to volatility in financial markets. But I have to tell you, I feel a lot more comfortable about the risks today than I did back in early December when I was making the forecast for 2012. And for the record, that's as positive as I get in this presentation. So what about the US economy? Well, the US economy has been recovering since mid-2009, but you'd have to say it's been a very half-speed economic recovery. A normal recession recovery is the economy would sink 2%, the next year it would grow by 4%. In this case, the US economy sank by 5.1%, and ever since it's only been growing at about 2.5%. So it has been growing. It's just the pace of growth has been very moderate compared to what you would have expected in a normal cycle. So if we go back to 4 to 6 months ago, you might remember the financial press was filled with stories about the possibility of a renewed US recession. There was people saying there's a 40 or 50% chance of a new US recession. You know what? It didn't happen, and their fears didn't play out. All of the activity numbers are telling us the US economy is growing. And the recent job numbers are looking better. You know what I find interesting, though? Financial markets have been almost euphoric about the US economic data being so much better. You know what my tracking is for first quarter economic growth? It's 2.1%. What this tells you is the euphoria is over the fact that the US economy is not having the slump people were fearing. But the story in the United States remains the same, that it's most likely going to have very moderate growth because they still have to deal with a lot of structural problems left over from the financial crisis. You ask an American what's the number one challenge, they'll tell you it's unemployment. And you know what? That's a very fair assessment of things. But my attitude is that if you get rid of the impediments preventing the economy to grow, the growth will actually allow jobs to be created, and then that problem will diminish. So when I look at the structural problems in the United States, one of the biggest ones I'm still worried about is the housing market. Home prices in the United States have now sunk 36% from their peak, making it the biggest, this is worse than in the Great Depression. And when we think about the outlook, it looks like home prices are going to continue to fall over the near term. The reason for this isn't demand. Affordability is great. Lots of Canadians are buying real estate in the United States. Affordability is fantastic. Sales are actually rising. We're actually seeing people buying houses. The problem isn't demand, it's supply. A healthy inventory of unsold homes in the United States is 4 months of supply. Right now they're at 6.5 months of supply. That's 50%, more than 50% higher than they should be. But when you add all the foreclosed homes that haven't been listed for sale, it's actually 13 months of supply. And in states like Nevada, it's 16 to 19 months, like in Nevada and Florida, the really hard-hit states. My world's really simple. If you have limited demand and an enormous amount of supply, right, prices are going to remain under pressure. So this year, home prices in the United States will probably fall another 5%. I think they probably should start to stabilize next year, probably putting in a decline of maybe 1 or 2%. But the US financial system still isn't operating normally, and the housing market is part of the story. It's not the whole story. A lot of the story is that American consumers don't want additional credit because they're deleveraging. But there's also a big part of the story that is the housing weakness in the housing market is preventing the circulation of credit. When I do presentations to university students and we talk about relationships and how the economy is doing and that sort of thing, and you get to talking about the US economy, you get students asking you a very good question, which is, how can you have a 0% Fed funds rate and not have strong economic growth? The reason is that the interest rate doesn't matter if no one is willing to give you a loan. So a good example of this is that in the United States, in Canada, we have something called recourse mortgages. So if you take out a mortgage of $300,000, then your price of your house falls to $250,000, If you hand the keys back to the bank will sell your house for $250,000, and then we will come after you for the other $50,000. In the United States, most of the states are non-recourse states, which means that the price of the house falls in value. And you go back to the bank and you say, okay, my house is only worth $250,000, here are the keys. The bank is the one that eats the $50,000 loss. What do you think that does to the incentive to lend money in an environment where home prices are still falling? Right? It impairs it. Another example, you're an entrepreneur, you want to start up a business. What do you often use as collateral for the start up of your business? For the loan, right? The value of property, which has now fallen 36%. So there's a lot of impediments still in the housing market that have to be worked out. And as a result, although money has been pushed into the economy, billions of dollars have been pushed into the economy, it's having a limited impact because money's not circulating normally. I think with time, what we will see is the velocity of money, the circulation of money improve. I think we'll see credit starting to improve. And we're getting early signs of this. And I actually think the private sector in the United States will show steady improvement this year. I think by the time we get to the end of the year, we will find out that probably about 200,000 jobs were created each month, and that's actually a good number. It should help to bring down the unemployment rate by a few tenths of a percentage point. Not a lot, because I think a lot of unemployed workers will start coming back into the labor market. But when we get to 2013, I get worried. Because in 2013, at the end of this year, as we head into 2013, a lot of the support programs the US government has put in place are going to expire. At the end of this year, the payroll tax cuts, the emergency EI benefit, the Bush tax cuts are all going to expire. The other thing out there is, from a fiscal policy point of view, the complete fiasco over the debt ceiling increase last year in the United States is posing a big risk. Now, if you remember what happened back then, the US government needed to raise the amount of debt that they could issue. They'd done this 71 times in the past. It had never been a problem before, but this time it was, because the political system in the United States has become so polarized. So the parties couldn't agree. And ultimately, at the 11th hour, they finally said yes, they'd raise the debt ceiling. But when they did it, they said that for every dollar that they increased it, they had to find $1 of fiscal savings. And so they set up something called the Joint Select Committee, or the Super Committee, that was supposed to find the savings. But in order to make the committee agree, they said that if this committee didn't actually find the savings, it would trigger automatic spending cuts starting in 2013 of $200 billion a year for 9 years. The committee didn't agree. So they have triggered the automatic spending cuts that will start in 2013. So when you stack up all of the expiring programs plus the automatic spending cuts triggered by the Budget Control Act, the amount of fiscal drag in 2013, if nothing is done, is 2.5 percentage points. You know what my growth forecast for the United States economy is in 2013? It's 2.5 percentage points. It sort of drives home the point that the risk they're playing. Now, this can be avoided, and I have to assume, just like I do in Europe, that rationality will win out, and that ultimately they know what's going to happen, and they will ensure that it won't, because it's not an acceptable outcome. But it's politics, and that makes you very uncomfortable. I don't know how well Washington is going to function after the next election. But it's absolutely essential that fiscal policy is changed to allow the US economy to continue to grow and avoid this sort of headwind. And I think as we get later this year, I think this is something financial markets are going to start to get agitated about. So overall, the bottom line is the US economy is growing. It's growing at a slow pace. Fiscal policy is going to become a big drag. Now, to deal with that, in that environment, the Federal Reserve has said that they are planning to keep interest rates low for a long period of time. And I gotta say, boy, has it gotten easier to be an interest rate forecaster. When the central bank says we don't plan to raise interest rates until at least late 2014, guess what my forecast is? Right? But think about it. If the Fed leaves rates at this level all the way to the end of 2014, The Fed funds rate will have been at 0 for 6 years. Now, let me recap the US story for a moment. The US had a credit bubble. The credit bubble created a real estate bubble. The real estate bubble burst. It impaired the banking system, created a huge financial crisis. The government had to respond, but the government's having a lot of difficulty dealing with the structural problems left over from the financial crisis. As a result, the central bank has taken interest rates to 0, and it's going to keep them there for several years without creating strong economic growth. Does this sound like any other economy to you? Well, it sounds a lot like Japan to me. The parallels in broad strokes are very similar. Real estate bubble collapses, financial system becomes impaired. Government has difficulty dealing with it, interest rates go to 0, and they have the lost decade, which you now have to add an S to, decades. Now, there is a big difference between the United States and Japan. During the lost decade, Japan grew at 1%, but I find 1% or 1.25%, but I find that number very interesting. Because over the long haul, your economy grows either because you have more workers or you use those workers more productively. Okay, let's think about the Japanese situation. They actually have decent productivity growth. However, their demographics are awful. They have an aging population, the population is contracting, and they have very weak immigration. As a result, while productivity is rising at a decent pace, the population is contracting. So when you add the contraction in the labor force to the productivity growth, it tells you the trend rate of growth for the Japanese economy is about 1%. Okay, so if we take the Japanese lost decade experience and we transpose it to the United States, what's the trend rate of growth for the US? Well, the US is one of the most innovative, productive economies on the planet, and while population is aging because of the baby boomers, the US demographics are actually better than any other advanced economy. They actually have the fastest population growth. And they have good immigration policies. So if you add labor force growth plus productivity, it tells you the US economy trend growth is about 2.5%. So guess what my forecast is for the US economy over the next couple of years? Trend growth of about 2.5%. This is basically in line with its long-term average. Now, when you think about that forecast, it has different implications. On the positive side, 2.5% growth is growth. The economy's doing okay. It's growing. It should create jobs gradually over time. From an export point of view, it means Canadian export, demand for Canadian exports will be moderate, not booming, but not terrible. At the same time, from an investor point of view, if the US economy is growing at 2.5%, corporate profits should rise about 6%. Add on 2% for dividends, that would mean US equities should deliver about an 8% return if you assume no change in price to earnings multiples. 8% is not a bad outcome, right? It's quite a reasonable rate of return. So this is not a terrible environment. The only thing you have to keep in mind, though, is it means that you never actually got above trend since the recession. And that means a lot of people that lost their jobs during the recession are not going to get integrated back in the economy. It means youth unemployment is going to remain very, very high. In other words, the socioeconomic outcome of this is not great. It creates a lot of challenges. So I think there's going to be a lot of frustration in America. I think that the American economy is not going to deliver the opportunities they want, because in order to get those opportunities, they need a period of growth that's in the 4 to 5% range. What they're going to get is about 2.5%. So this isn't a terrible outcome from an economic perspective, from an investor, from a Canadian perspective. This isn't a terrible outcome. But for a lot of Americans, this is going to be very disappointing. So how are you feeling? Let me tell you, this is a lot more upbeat than it was back in December, before we got some decent activity numbers and job creation numbers. And I tell you, I was doing presentations last December, and there was an event I was doing in Toronto, and there was a bar at the back of the room. And as I was speaking, people were getting up and going to the back and getting a drink. And I've never actually had it happen before. So in the Q&A, I remarked on it. And one of the people in the crowd yelled out, "Well, they came back." No, it's not a really upbeat presentation, but it's a very pragmatic assessment about what's going to happen in the U.S. It isn't the world's going to end. It isn't the U.S. is going back into recession. It's basically a story of an economy that's dealing with an awful lot of structural legacies of a credit boom. So when we turn our attention to Canada, the reason why I've spent so much time on the international backdrop is so much of the international backdrop impacts us here in Canada. You know, more than a third of the Canadian economy is exports. 73% of our exports go to the United States. So where the U.S. economy goes, so too does Canadian exports. Now, the slowing in the emerging market world should limit the upside to commodity prices. But quite frankly, I don't think commodity prices are going to decline significantly. I think base metal prices will remain elevated. I think we'll probably see a gradual improvement in forest product prices over time. However, on the energy side, I don't see any possibility for natural gas prices to come up significantly given the amount of shale gas that's out there. But oil is a huge wild card now. And you know what? It's the risk that we weren't talking about in December, which has now suddenly jumped onto the page. So as the other risks are diminishing, oil just suddenly became a core risk. Now, if we weren't having tensions with Iran, the price of crude oil today would probably be about $90 to $95. So the geopolitical risks are elevated because people do not know what's going to happen with Iran. And quite frankly, I don't have a good answer for you. It's a risk to the forecast because I don't know how things will play out. I got to tell you, it's very uncomfortable, right? When a nuclear scientist in Iran is assassinated, and the Israeli government comes out and says, "Yeah, we did that." When the newspaper starts reading like a Tom Clancy novel, I start feeling uncomfortable, right? And if you actually had a major problem in the Middle East, the price of crude oil would be dramatically higher. It would slow down global economic growth. If that doesn't happen, odds are the price of oil is going to remain high. It's going to be a challenge in the United States. It'll dampen some consumer spending. It'll dampen some consumer spending here in Canada. But overall, the global economy can weather it. The big challenge outside of the commodity sector is going to be the strength in the Canadian dollar. And the Canadian dollar, in my opinion, is going to remain close to par. I think we're basically a trading range. We go up to $1.05 or thereabouts when it's strong. We go down to about 95 cents when it's weak. But if you had to actually average out the volatility, it's probably going to be about par. That's what I'd use for a 5-year plan if I was, from a business plan or from an investment plan. So we're going to end up with moderate export growth. But governments are now turning their attention in Canada to deficit fighting. And, they're taking a very Canadian approach. They're taking the middle of the road. So at the one extreme, we have Europe, which is going after deficits in a hack and slash fashion. And the amount of fiscal austerity they're applying is actually causing their economies to run the risk of going back into recession. Put aside Greece, put aside the periphery. The UK government is tackling their deficit far too aggressive, and it's running the risk of causing the UK economy to slump. Okay, this is not a good approach. At the other end of the spectrum, we have the Americans. Last year, there was a budget proposal put before Congress to eliminate the deficit by the year 2040, and it was deemed too aggressive. Which means America is not having an adult conversation about their finances. And in between these two extremes, we have Canada, the Canadian government saying, listen, we recognize that when we had a recession, we use fiscal stimulus. When we get out of the recession, we eliminate deficits, but we eliminate them over the medium term. We do it with credible medium-term plans, and the speed at which we do it is dependent on where your starting point is. So in the case of the federal government, they're aiming for 2014, fiscal 2014, 2015. Here in BC, the target is fiscal 2013, 2014. Because the challenges are slightly more manageable. And in the case of Ontario, it's probably going to be 7 years. But that probably is about as fast as humanly possible for Ontario to deal with its deficit. So each province is different, but the story ends up being the same. The story is, let's get back to balance over the medium term. Let's constrain program spending in order to accomplish this. Let's try to maintain competitiveness by not raising a lot of of tax revenues, but let's do it over a time frame that the economy can weather. Will people like this? No, they won't, but it has to happen. Now, from the point of view of the impact on the economies, my assessment is it probably slows Canadian economic growth by about 0.5 percentage point each year, which is, again, manageable. But in response to the fact that fiscal policy will be tightening, there is an offset. The offset is interest rates in Canada will remain lower for longer. I don't think the Bank of Canada will raise rates before the second half of 2013. And this should be good for domestic demand. It should help to support the domestic economy. And where the Bank of Canada really wants to see strength is business investment. They hugely want businesses to run out and invest. I know in this slide, business investment looks really weak in the first couple of quarters. I got to be honest, my forecast was that things were going to go from bad to worse in Europe before they got better. If we think about businesses from business investment, there's every reason to invest right now. First of all, corporations have good, strong balance sheets. They're sitting on tons of cash. Interest rates are incredibly low. Government policy has become very attractive. With the reduction in the corporate tax rate at the federal level, lower provincial taxes in general, accelerated depreciation allowances, and you could go on. There's lots of incentives to invest right now. Right? And about 70% of our machinery equipment is imported, and it's priced in US dollars, so it's cheap. The missing ingredient is confidence. Now, my intuition was that businesses would feel pretty unconfident or pretty worried as we continue to see a lot of the global risks play out. Well, so far so good, because so far the risks aren't playing out as badly as I initially anticipated. So maybe business investment is going to be a little stronger in the near term. And as those risks diminish, I think business investment should be the #1 catalyst for growth in the domestic economy. And let me tell you, we need it because our productivity stinks. So the Bank of Canada desperately wants businesses to go out and invest. They want them to take advantage of low interest rates. They just don't want consumers to. Because personal debt in Canada has now reached 153% of disposable income. It means Canadians are now more indebted than Americans, and we're rapidly closing in on the 160 mark that the US had, which makes the Bank of Canada very nervous. This is why the Bank of Canada has been emphasizing for quite some time that people need to be careful about their finances. I've been very vocal about emphasizing that people need to recognize that interest rates, when they go back to normal, rates are going to go up 2 or 3 percentage points as a minimum. When you say that in a real estate crowd and you have a bunch of young people, you just watch them freak out. And then you have to say, could you please have a conversation with the gray-haired gentleman at your table about the level of mortgage rates? And all you hear is, I remember when I had 18% in the early 1980s, right? Well, we're not going back to that. But interest rates cannot stay at these levels indefinitely. Now, I really do feel like the little boy that cried wolf, though. Every year I say, listen, right? Interest rates only have one direction to go. They're going to go up. Be careful. And then a year later, interest rates are lower. At the start of this year, I said, be careful. Although we don't think the bank is going to raise rates, bond yields will rise. Interest rates will come off their current floor. So mortgage rates are going to rise. Be careful. And then Bank of Montreal introduces a 2.99% 5-year fixed mortgage. Bastards. Right? So at the end of the day, I keep warning people to be careful, and time passes without the problem happening. And what I have to always remind them is if you go actually read the book, the wolf does show up at the end of the story. I just don't know how many chapters there are in the damn book. So what we're seeing is Canadians are starting to get the message. Debt growth has slowed to about half the rate that it was before the recession. So we're seeing much more moderate debt growth. I think the real problem is income growth has been so lackluster. So debt is still a pressing problem. I think that the consumer is pretty much tapped out. I think employment growth will actually improve because it's been very bad the last 6 months. I think employment growth will gradually pick up. I think income is going to rise just slightly more than inflation, but not a lot more. And given the amount of debt people have, the consumer is going to deliver relatively modest spending growth. And it's 60% of the economy. So when you add up the components of GDP, and those of you, some of you suffered through first-year economics, and if you did, I'm truly sorry. But if you add it up, right, it's consumer spending, business investment, government spending, and trade. So what do we got? We've got modest consumer spending, modest to moderate exports with an emphasis on commodities, strength in business investment, but a drag from government. What's the net result? Well, an economy that's going to grow at a relatively moderate pace of about 2% over the next couple of years. Now, I've actually raised my forecast. This year it was, in December I thought it'd be 1.7%. In the next week or so we'll be publishing new numbers and they'll be closer to like 2.1. So we've actually raised it a little bit. And when we look across the country, you have to add about 0.4 of these numbers. When we look across the country, it's basically the same sort of story, but with more strength in Alberta and Saskatchewan because of energy and commodities. The BC economy, we think, will basically average close to the national average. So I would expect something around the 2% mark. Vancouver tends to be a little faster than the provincial average. I'd expect Vancouver to grow at about 2.5%. So a gradual pace of growth, not booming, but not a bad outcome. So when we think about, for example, employment in Vancouver, I think employment's probably going to rise about 1.5% to 2%. The unemployment rate will come down from 7.7% to 7.2%. So the trend is generally your friend, but it's not a booming conditions. It's a pretty decent outcome. So when you think about it overall, the BC economy actually, it's not going back to the 4 to 5% rates that we had in 2004, 2005, 2006. Right? But it's a fairly steady as you go sort of economy. And in terms of real estate, I think that basically the market is going to be pretty flat. Now, do understand, I am worried about overvaluation in real estate in Canada. I think on a national average basis, overvaluation is probably about 10 to 15%. I think the overvaluation is not spread equally across the country. There are certain markets that we are particularly worried about. But the basic story is that if you want a correction that's going to unwind the imbalances in terms of the overvaluation, you need a catalyst. You need something that's going to cause the correction. Well, what's the two things that tend to cause real estate corrections? Right? Number one, rapidly rising interest rates, or two, rapidly rising unemployment. Well, think about what I told you about the Bank of Canada, right? The Bank of Canada can't raise interest rates significantly when the Fed is on hold. Otherwise, the Canadian dollar will go to the moon. So we can't have an interest rate shock in the near term. The other one is unemployment. And quite frankly, I don't see the elements for a major problem on the unemployment side, unless one of the acute risks out there play out. So if you take those two components together and you say, well, we don't seem to have a catalyst for a big change in behavior, but we know affordability has deteriorated significantly. We know Canadians have taken on a lot of debt. Then the basic story you should come to the conclusion of is a gradual moderation in activity, not a major correction. Right? Now, in truth, you always got to be a little sanguine about these things, or not sanguine, but you have to be a little careful about these things because, this is the ideal outcome. The ideal outcome is a gradual unwinding of the overvaluation, price growth being pretty flat, personal income rising, and that takes care of the problem. And you know what? That would be the perfect outcome. The problem is history tells us that it's not the most likely outcome. But at this point, over the next 2 years, I just can't see the shock that would cause the major correction. But like I said, we are worried about certain markets. As a general rule, anytime I find a slide that looks like a hockey stick, I get really nervous. And in truth, there is a lot of uncertainty as to what's happening and what's driving the Vancouver real estate market. Forecasters actually don't know, don't have a good handle on it for two reasons. We actually do not collect information on how much foreign buying is actually happening in the real estate market. And number two, we actually do not collect information on how much speculation or investment is being done in the real estate market. All we have are sales and listings and price data, which means we truly cannot understand what's happening beneath the surface. So OSFI, Bank of Canada, CMHC, different groups are all working on surveys to try and understand what's happening in the market better, capture what is happening so that we can understand it. I'll give you my intuition. I'll bet you we get the survey results right after the market has corrected. You know, I almost want to work backwards. Like, so when do you think you're going to get the results? You know, so I can figure out where the risk time frame is, right? But ultimately, we do need to understand what's happening in the market. It is clear that the markets that are most vulnerable right now, particularly on the basis of affordability, is Vancouver is number one. The second part of the market we're really worried about is Toronto condos. There's currently about 135 condo towers going up in Toronto. You know, in the city of Chicago, there's 12. You know, multi-unit building in Toronto is up 40% year over year. So the question is really about, you know, can the market absorb all those properties? Or is there going to be a price correction when all of a sudden you can't find enough people to put in them? Oddly enough, the other two real estate markets flashing yellow lights, not red lights, is Quebec City and Montreal, which I find a little perplexing. And I think it has to do with how their prices have increased. It's a function of how the underlying economies have done, and therefore what sort of pricing they can actually support. So those are the other two markets in Canada. So I would stress to you, I do not think we have a US-style problem on our hands. I do think that there is risk in the real estate market. I do think there's risk from household debt. But ultimately, I don't think we have US-style problems because largely we don't have the inappropriate and high-risk behavior that we had in the US market. I hate that slide, though. The last comment I'll make is just from an investor point of view. If you're thinking about your portfolios and your investments, you know, if you're in cash, you're losing money because you're not even getting paid inflation. If you're thinking about bonds, bonds are the new cash, because if you're in bonds, you'll basically get inflation plus a little bit, but actually not enough for wealth accumulation. If you want to be in, you know, you could be in equities. In equities, I think that the economic fundamentals would support returns of about, you know, high single-digit returns, say around 8%. Which actually isn't very, you know, that's a pretty decent number. As a general rule, we like high dividend-paying stocks in an environment where interest rates are so low. The one thing I would stress to you is that we probably will have a lot of volatility, and so I'll end on an anecdote on that. And you know, I was last year when the market was swinging all over the place and the market plunged on news about Greece. I was doing a CTV interview, and the host of the CTV program kept asking me, well, what do you tell investors to do? And I said, well, I'm an economist, I'm not a stock picker, I'm not a financial planner, you know, and wouldn't let me off the hook. You know, no, what do you tell investors to do in this environment? And I said, okay, fine, turn off your television sets. Right? Now, when you do interviews on TV, that, you know, you have an earpiece and you can hear the producer, and the producer says, you know, 3 minutes to you, 1 minute to you, 30 seconds to you. Then you never hear from them again. Right? This time, you know, I said, turn off your television sets, and immediately you heard the producer come on, nice job. But in truth, it probably is the right recommendation in this environment. Because think about the risks that we're talking about. Risks about European politicians dealing with their fiscal crisis. Risks about gridlock in the United States. Risks about political tensions with Iran. What's the common thread in all of these risks? Right? It's geopolitics. And you truly do not know what is going to happen on the political front. So I do think it's going to be a difficult environment as people try to work through what's going on and how the risks are playing out. I think that creates a lot of volatility. But at the end of the day, you know, we navigate through these things, and there's nothing you can do from an investment point of view to anticipate them. You just ride through the noise.